So, welcome to the Masters of Real Estate. Today, we are going to learn from Ted Farry. Ted, so how do you introduce yourself to a target customer or an investor when you meet them?
It's great to be here, Nick, and here with the team. I love working with you guys and very pleased to be here. And thank you for the opportunity. I'm an executive and consultant to the institutional SFR space. You know, that stems from some early experience that I had in the first part of my career. Maybe call it a juxtapose experience. One on the one side, very much focused in the physical part of real estate and construction and transactions. And then on the other side, really digging deep on analytics and data. And it really kind of highlights one of the things that I like most about single family is that you have this opportunity to work in something real, but it's bad. The volume of things that you're looking at, the volume of houses, it creates such a strong opportunity for data analytics, which is, something that I've built some strong skill in and I'm really interested with. And so all of that built a great foundation for me to, step into a primary focus in the institutional SFR space really over the last, decade plus.
Wow. So would it be accurate to summarize that you are basically an executive and a consultant in the single family space, and it's primarily due to your experience, not just in construction and financing of single family homes, but also the analytics and the ability to use data really well to think about the single family housing market?
Right. How I view it, and I talk about this all the time with my team and people I talk about, the industry with, is that there's no single decision in single family that's going to make or break your investment or your business or your platform. In fact, it's more the overall process and how you deal with a multitude of decisions and activities over a longer period of time.
That's amazing. So Ted, what is the main operating principle of your life? Like, how do you distill your decisions down to your core operating principles?
I'm a hard worker. I think it's probably the primary thing. I think I love to solve problems, and if I don't have the exact right skill set to do it right from the start, I kind of bulldoze my way through with hard work at the start and pick up and learn the skills that I need to do it again in the future. I think that's really kind of how I've amassed a skill set right now that's applicable to SFR. Just dive deep. It all starts with the problem, right? I love to solve problems. And so it starts with the problem, and, the bigger, the hairier the problem, the better. And, just dive head first into it and start working through it. You're probably going to have a lot of problems and failures at the start, but hopefully, with hard work and work through and figure out what's needed to accomplish it and solve the problem.
Wow. So what kind of an animal or a bird best describes your operating philosophy, which is the philosophy of working hard and solving challenging problems?
I don't know if I've ever been asked that before. It's pretty interesting. I think probably some sort of a bear.
A bear.
Maybe not like a grizzly bear, but probably like a big brown bear or something. I'm gonna move forward in the direction I want to go. And if I can be kind of athletic when needed to accomplish some bigger tasks.
That's amazing. Relaxed and aggressive. Yeah, I love it. So what inflection points led to your bare philosophy of hard work and solving problems to focusing on SFR right now?
Yeah, I think the first point, and by the way, these are fantastic questions. I love them. I think the first point was really when the first real job that I had. I was working with this luxury spec developer in Manhattan Beach, where I'm from, Dennis Maloney. Very successful person, and it still is at the forefront of luxury home construction and development in Manhattan Beach. And what I really learned, and kind of, it was my first exposure to professional exposure. And there's just some basic things like hard work, staying at it all the time, staying organized. He made me, on one of my first days, he handed me a clipboard with a stack of blank sheets of paper and, told me just to start making lists.
A list of what?
Just lists, like to-do lists, basically. It was like, just stay organized. There's going to, he was constantly asking me to do things. And, over time, I think it turned into more notes about, things to stay on top of. And I think at the core of it, like that really ingrained just accountability and a method and to accomplish things, just breaking, we're building these multi-million-dollar houses, and just so the ability to break it down to something as simple as a list on a piece of paper of everything that you need to do to accomplish the construction of the house. Obviously, I wasn't building the whole thing myself. It was my little piece of it. And as I worked with them longer, having the context to do it, understand how I fit into the bigger process, so that was a real, I think strong, it was a dose of reality, not a kid anymore. And things got real. I could tell all sorts of stories about working with Maloney. I stay in contact with him. Great. It's a relationship and person I really value, having had him in my life. I think the next one, it didn't come that long after, but it was the opportunity to work in CMBS securitization at Countrywide right during the downfall, right? Right before and during the downfall. So again, a really strong relationship, a friend of mine who I'd met fairly recently, but who was, just another kind of more mentor type person to me, or is Marlon Marinkas. She provided this opportunity for me to come and join her team. I'd worked in construction and home building. I had some math background. Besides that, I really had no experience or exposure to structured finance or anything Wall Street. And so it exposed this whole new world to me related to capital. It opened up this professional opportunity to work on analytics, which we've already talked about as something that, I love and really enjoy working in. And, I think maybe for entertainment purposes, at the very least, that it provided me with some front row seats to financial meltdown, which, again, things got real on a whole different level with that one. So, probably the third one is getting married and starting a family. And, I think that one's probably a much more, fast, simple, and straightforward answer. That's the foundation for doing everything now. So.
Wow. Thanks for sharing. So basically from meeting Dan Maloney and working Manhattan Beach, which basically your first real professional experience, to fast forwarding to being at Countrywide and securitizing CMBSs and being on your desk when the whole world seemed like it was melting down financially, to finally putting your roots down, brought you to where you are today, which is focused on, obsessively focused on single family housing and using analytics on single family housing. So with that in mind, what is your number one quantitative goal in the single family housing space this year for 2024? And the follow-up to that is how are you doing compared to, you have set your goal as for the end of the year?
Working in acquisitions, I think we always look to place a number of houses bought. For 2024, our target is to buy over 1,000 houses. It's not quite going how we'd like, and primarily just because of the consistent movement and fluctuation in the cost of debt. So we're probably moving a little bit slower towards that goal than we'd like to. We started off really, really great. I think that's the simple way to describe it is hitting an acquisitions count. But the bigger thing behind it is everything that goes into that. So along with that is consistently working to build and get better in as far as our acquisition system. We're consistently, you're very well aware with you and your team, how much new data sources and process improvements we're consistently doing to make our system better and more effective and more usable. Our team is core to that, our acquisitions team. So, I have daily calls with my acquisitions team. A lot of them end up just being quick, kind of touch base, work through the pipeline. But we've also improved our process there. And, I think there was a lot of things that we have, a lot of problems that we realized that we had solved over the years. I've been with Fortune Acquisitions for 5 years. Since I joined Fortune, there's a lot of problems that we've solved. And as we've gone through the different, fluctuations in the economy and the market, you end up focusing on different things. At one period, we're focused primarily with private investors doing long-term rentals. Another time we might be focused on flip properties. Now we've been primarily focused on buying for an institutional client. So you have different problems that, come around at different times. And so we had a new set of problems that weren't actually new. We realized kind of at the end of the year, it's like, hey, we already solved this 3 years ago. What was our answer then? And so part of the realization there is that we can be better at documenting our process and what it is that we're doing. So that's been a real primary focus to start off the year, is just being very detailed and documenting our processes, making sure that they're put together and accessible in a way that they can be a valuable and quick resource to anybody who needs them, primarily our acquisitions team. And then having, a regular cadence time to go over it. Like, we don't want to talk about process and documentation every day. It's valuable. So what we've done is just carved out a time every week where we can lay out the things that we're working towards, establish, key responsible parties to tackle those things, and attach some metrics to keep people accountable, but, mostly to build that team effort, right?
Makes a lot of sense. So 2024 goal is to acquire 1,000 homes. It's not going well so far, and primarily you're working on process standardization and improvements. How big of an impact is the rate environment having towards being a bottleneck on acquisitions?
I mean, there's multi-facets to that. I think on the first one that is probably the biggest mover is that the more expensive debt is, the higher our cost of capital, and the less, the lower our purchasing power. We're just able to, we're less competitive in the market, regardless of what is happening elsewhere. I think the next one that's probably a pretty close second is that the effect on supply and values in the market is not necessarily like a direct intuitive result of the largest increase in interest rates that we've seen. I think that to boil it down to just the effect on supply, even though the retail buyer lost so much purchasing power themselves, we're still in the midst of a huge demand supply imbalance. Even though a buyer lost so much purchasing power for their ability to go buy a new house, the direct effect on supply has been that there's less houses available to buy. We're in the middle of this supply versus demand imbalance that we have been in for a long time, 5 to 10 years, and it seems like we'll continue to be in for quite a while because of a number of different things. The rise in interest rates, while you'd think that because the loss in purchasing power that the retail buyer experienced would reduce values, it actually had, kind of a muted to almost opposite effect, in that those people, like the population of retail buyers, a lot of those people already own houses. And if they refied it to 2 or 3%, I mean, this isn't anything new. People talk about this in the market a lot, because those people it doesn't make sense for them to move on and buy a new house. That also, reduces the supply of available houses, for sale. Even though this rise in interest rate had such a muting effect on purchasing power, because the supply of homes is so low, values have actually still gone up during this period. Taking it back to like what the effect of rates are, it's like, yes, we're able to buy less, and it probably reduces, competition among the institutional buyers, because there's just, they also have the same thing happening to them, but there's less houses to buy.
That makes a lot of sense. So fundamentally, the three bottlenecks towards achieving your ability to hit your 2024 goals are: one is process standardization and optimization, the lack of inventory available to buy in the market. And even when there is inventory, it's priced really high because of the low supply in the market. And 2 out of the 3 aren't going to change, like you said, for at least the near future. Who knows what will happen in the distant future? Right.
Well, and the path out of it, obviously, if rates come down, that'll change things. But who knows what the effect that'll have on the current sellers that aren't moving? I think that's an interesting one to talk about. There's a lot of potential dynamics. But the other piece to that, the other path out really is rental rate growth. There's such a strong demand for housing in general that it's also raising rental rates. And so that the numerator in a cap rate, gets corrected by that.
That makes sense. Yeah. And that, I think, brings to a very core philosophical perspective, which is for the average John Doe or Jane Doe listening to us right now, they have a misconception that Wall Street owns a lot of single family homes. What is the truth? Like, it's not really that case, right?
Well, right. I mean, I think that as far as like misconceptions, I think there's two biggest ones that I talk about all the time. I mean, the fact that institutional ownership is providing housing in general, I think that's one that's talked about more. It gets erased from the picture. It's like either somebody will be sitting on that house and having it not available either as a second home or whatever. Like it's not something, not as a rental. It's not available for somebody to live in. So the fact that this institutional ownership is actually creating a solution to housing and that making more housing available to be lived in, I think that's one key misconception. The other one is that if you trail the investment dollars in these institutions in many, many paths, you probably get back to Main Street, folks anyways. A lot of the investors in these funds are, go back to pension funds. So you're talking about firefighters, teachers. And so it's not actually, I know that the brand of the institutional investment is a, large Wall Street company, but, or other. It's not even Wall Street, actually. It's more, private funds that are doing the buying. The capital is coming from Main Street. And so you're like the people that are getting attacked are actually investment dollars from, in some cases, the people that are actually doing the attacking. So I think that's just kind of a weird dynamic that's out there that is definitely a misconception.
Yeah, makes a lot of sense. They want their pension accounts to grow at a higher than market rate, but they also want to dictate where the pension money goes towards. It doesn't work both ways, right?
Right.
I think that the third misconception is also, and maybe you can correct me on this, is that you are also not overpaying for the home. So if someone really wanted the home you're buying, they could pay for it and buy it. You're actually paying less than the market value of the home in certain scenarios to be able to make even neutral returns or positive returns on the rents that you'll get from those homes. Family really wanted to buy the home, they could just buy it outright.
Well, right. And if you go back to the start of the institutional activity in SFR, one of the core pieces of the thesis was buying at a discount to replacement value, right? It was never, I'm going to go pay more than anybody else so that I can gain market share. Although that's been a part of, many people's kind of strategies at certain points, but it's not a core facet, and it doesn't make sense, right? So.
Yeah, exactly. I think that there are three very well laid out misconceptions on Wall Street versus Main Street. So first of all, there's no Wall Street, Main Street. It's all coming from the same bucket of dollars, which is the 401ks and pension accounts. And that's what's growing really at the end of the day. The second is that, these properties are actually being bought for lower than market price. So if you really wanted to buy them, you could, but you probably won't because you don't really want to put in the blood, sweat, and tears to fix them up and, do what's needed for them. And the third is that despite all that, the overall volume of institutional ownership is very, 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 very low in percentages compared to retail home buyers. They own a super majority of the housing market stock.
Well, right. Yeah. The overall housing stock, I think it's something like less than 3% is what institutional ownership still makes up. And then if you look at even a little bit of a smaller bucket, but still very large, are owners of single family in general, it's still something like 85% owned by people that own less than 10 houses.
That's right. Even on that 3%, the super majority of the 3%, like you said, is mom and pop home buyers or homeowners, not really institutional capital. So now that we've gotten that out of the way and we have cleared anyone accusing us of anything, let's focus more on the process as to how you find these homes and buy them. So what is the process of you finding acquisition targets, diligencing them, buying them, stabilizing them?
We view things as single opportunities, and really we're trying to get houses from whatever source that we can. The primary sources of that are, MLS. I think that's the vast amount of opportunities that come into the system, but it takes a lot to evaluate and pinpoint what opportunities are a fit or where we can be competitive with our pricing. The next one is, we'd separate to be like off market. And so there's a lot of different type of off market opportunities. Probably the largest source of that would be from local market investors or wholesalers. And that takes a lot. I think, as we talked about before, we may not always have the highest bid. In fact, we almost never have the highest bid. And so it kind of becomes a little bit of a dance with the wholesalers to be the second tier buyer or, or even buyer of last resort. And so the timing, being in the right place at the right time is crucial. And, I think that we get that by constantly working to build our network of different wholesalers and then maintain it and strengthen it, so that we gain a reputation of being somebody that a wholesaler or investor could know that they can get a sale done with if they have to. Third area of that are really builders and new construction. And I think we've kind of gone in and out of that really being a viable option up until just before we started to see the strong increase in interest rates. We were so not competitive on that pricing that we really didn't even review those opportunities. But then because of, things happening with cost of capital and debt, availability of debt, and different situations that different builders, mostly kind of like regional to super regional type of players, found themselves in, that, having a buyer of last resort like us or, another institutional investor started to be a better option.
Makes a lot of sense. So 3 sources, whether the property is listed on multiple listing services or not, which is MLS, or whether a wholesaler has already found a way to acquire the property or not, or whether a builder wants to sell the property to you instead of selling it for a higher price to a home buyer or not. Once you get all this data on which properties are available to be bought, what is your process of diligencing them? And how does that process differentiate between hard data, like quantitative data, and qualitative gut perspective?
For this answer, I'm gonna need to talk more with my hands. Yeah, at the top of the funnel, we may have anywhere from 200 to 500 leads coming into the system every day. So that's like the top of the funnel of all the potential opportunities that we could be reviewing. It is hugely expensive to have human labor to look at every one of those opportunities, and basically not possible. And so what our strategy is to try and leverage our system and as much data as possible to narrow down those opportunities to a much smaller set that makes sense for our underwriters to price individually. So we do that. Our first level is, as soon as an opportunity comes into the system, we have a set of internal data that we validate against and start to append to the records, use that to filter down the set. And then we're reaching out and again, making API calls. So, computers basically throwing data back and forth to each other. We're reaching out to the broader internet and gathering data to flush out those data records from as many different, basically either cheap or publicly available data sources. And then that helps us to get basically a systematic picture of the property as a data record. And then we can start to use that to plug into different filters or pricing, kind of general pricing metrics to establish a range like, hey, based on the data that we have, we think the pricing is going to, come out here. And then that's the set of houses that our underwriters then, basically manually go through to, we have constantly trying to provide better rankings for those to, for as a tool for underwriters, but it's that much smaller set that they're working through to find basically the houses that will work for any of the different buyers that we're working with.
Makes sense. So to recap this for our listeners, you find data from 3 sources: properties listed on multiple listing services, MLS, properties that wholesalers are referring to you, and in some rare cases, properties that builders are referring to you. All of these are 200 to 500 opportunities a day, and all of them get filtered through data to generate some sort of an intelligent guesswork on what is the real value of this property. Then that goes through manual review by someone really smart and intelligent, which is your underwriter, to check whether that's the right price or not. Now, wherever there is data generating intelligence, there's a potential of using artificial intelligence or automated processes. So how do you personally envision the role of artificial intelligence, or as AI as it's called, in this process of finding and acquiring the right homes?
Right. I mean, I think that there's a lot of different ways that you can apply that. In some of the conversations that I've had in the industry with other folks about this, I think that one of the first things you need to do is define AI. What are you actually talking about? I mean, I think it's now getting attached to everything, as basically is like a multiple increase or other sources of value. But when it really comes down to it, like, what is it you're actually talking about? I've had, I was on a panel in December at the most recent IMN conference, and I was talking with a PhD who's studied artificial intelligence and at the highest of kind of expertise in the area, and he's basically like, well, you could define it any different number of ways that you want. At the most simple level, we're already doing it. We have AI on our system in terms of workflows. We're utilizing a machine to make our processes, more effective and more productive. And I think as you kind of move up the spectrum, you might look at it as some way to replace those underwriters. Do you have enough data? And it might be more of a question of timing and resources, but is it possible that you could have enough data that would be able to train a model well enough to then replace that underwriter? And so they're actually doing that actual underwriting work. And then even further down the spectrum, how do you think about models, or are there models that could, just because of superior computing power, can they take these enormous data sets and then, basically have conclusions or draw conclusions that humans don't have the capacity to do? And so I think that's kind of very real. If you take the range of the spectrum, right? It's like on the one side with just is something as simple as workflow. It's like very real, simple, almost doesn't seem like it's AI. Whereas on the other side, it's like next step beyond that is like Terminator scenario where they're, doing things better than humans. And you think about it purely just based on computing power, are they able to just do things that are otherwise unimaginable by humans, right?
Yeah, it's massive spectrum, right? From basically just using better intelligent insights on one end of the spectrum to building a system that can decide deterministically better than a human underwriter what home to buy and what to price it for. There's a massive spectrum, and almost everything's called AI. So where are you in the spectrum, and where do you ideally want to end up at?
We're definitely, without a doubt, much more on that real side of it. We've spent a lot of time working through to build out a lot of different workflows. I think we start to get further, a little bit closer towards the middle, the more intelligence that we bring in. So this is, things like ranking, which ultimately just kind of comes down to pricing. I mean, that's the thing for us. It's like if it's got to check all sorts of boxes that make sense for our buyers, and then ultimately it's pricing that kind of drives that ranking. I've had some conversations with different folks and potential vendors about working on projects to be more towards that like kind of middle of the spectrum, like a replacement for an underwriter. I think it's much more likely in the near future that the tools that are created end up just being more like just like that. It's a tool for an underwriter, not a replacement for an underwriter.
Makes a lot of sense. Zooming out of this, for an institutional or even a heavy retail buyer of single family homes who already has a basic process of diligencing and acquiring properties, why should they use your platform? Like what do you do better than most other home buyers in the market?
I know we've put into the platform. It's not something that is like easy to build, and it's taken a long time. I think as far as aspects that differentiate us versus other folks in the market, I mean, we're bringing in. We really don't have a horse on the supply side, right? We're indifferent to the source of a property, and so for us, it's just about finding as many of the best fits for our buyers. And so I think we do that through all the things we've talked about, speed and execution, efficiency, but also it's just because we've been in the industry so long, myself personally and, the other partners on the Fortune platform, the relationships that we have, we're just able to bring in more opportunities to the platform.
So for a listener who is thinking about buying or is already planning to buy a lot of single family homes, the question they really have to ask themselves is, do they really want to invest 10 years and a lot of time and money into building their own platform, or should they just start using Fortune acquisitions tomorrow, right? And the answer, I think, is pretty clear, which is it's cheaper, better, faster to work with. fortune and use, the blood, sweat, tears, and the tremendous effort you put into building this platform to find and buy the right single family homes at the right price, rather than trying to do all that yourself.
Yeah, that's an amazing pitch. Yeah. Well, let me know if you ever want to work and look at an opportunity in sales with us. But
So
no, I mean, like, not to take anything away from that in our platform. I think it's very real, and that everybody still needs to have some base system that that you rely on. Otherwise, it's just going to be like a spreadsheet, right? I mean, definitely need to work, move, the cost of having a building system, whether you're going to go all the way to, build your own proprietary system, which probably doesn't make very much sense. The cost to get something as simple as like a workflow CRM type thing, like a Podio or a Salesforce, that there's entry level SaaS products that make it very, kind of cost effective to at least get some basic system. And then once you have those seeds, then the more that you do with it, you can plug into platforms like Fortune or other platforms in the industry. I mean, we have a lot of houses coming in, but there's certainly, a whole market of houses besides what we're able to pull in. And so I think the answer too is like, you just need to try a lot of different people. And then when it comes down to the specific opportunities that cover multiple platforms, that's where we can really differentiate, right? Is that, through effectiveness and, and connectivity and, customizability to our customers. So.
Makes sense. So zooming back into your processes, once you acquire the data for the properties and diligence them and price them, what is the right way to make an offer or buy a single family home? Like, what does the right bidding and closing process look like?
It depends on the channel. Mostly, like for the MLS or on market properties, we have the on market properties, we have the off market, and then we have the builder, segment. For the on-market properties, there's a very well-established process and method for buying houses. They're listed on the MLS, and you go and you submit an offer on a state form template to express your interest in the home. Our system is set up where effectively at the push of a button, that offer is put together and automatically sent from our local market offering agent that we work with. For an off-market opportunity, it's much less defined in terms of the method by which you make an offer. So it's sometimes, like if you're talking about a marketplace, it may be defined, like the method may be defined by that marketplace. So you might have to actually go to their platform. Like I said previously, we're connected via API to all the different platforms that we can be. So in many cases, we're able to also push a button in our system and submit that offer directly to the platform. Whereas on the other end of that spectrum, on the off-market opportunities with, like, say, wholesalers, that's one, it's really much more about communication and relationship. And so I think that because of the frequency that our team is communicating with these wholesalers and the relationships that we've built, they're going to pick up our call. Whereas it literally may be tough, even though you're trying to buy something, you're trying to be a customer of this person. A lot of the times it could be tough just to get them to pick up the phone or answer an email. So on the builder side, it's, again, primarily, there's a lot of value in relationships, I would say. Even for us, I think it can also come down to what is the right contact point for that specific potential counterparty. Is it better for us to reach out direct to that group, or is there another, whether it be a broker or a listing agent or just a person in the industry that we have a relationship with that is the best connector of us to that opportunity?
Makes sense. And eventually, once these properties are bought, the ideal portfolio would be diversified across multiple zip codes and states, which results in a difficult property management process, right? So what's the right way for a buyer of these properties in a truly diversified portfolio to manage them at scale?
When you figure that one out, let me know.
It's a very difficult problem to solve.
It is very difficult. And I think there has been so much progress as a result of the work of so many different people in the industry that have led to the answer to that question being dramatically different than it was, in 2012. I think it's still a very difficult one. I'd say coming out of the box, the best thing to do is find biggest not necessarily the biggest, but the multi-market operator, either national or multi-market operator that covers your footprint the best, that you think that you will be able to work with the best. It might be if, we work really closely with Home River Group, and they have the largest footprint and manage the most single family, properties for third parties than anybody in the country. For us, that works really well. I mean, we across so many different markets. We've been working with them for such a long time and have such a great relationship that we've had the opportunity to do a lot of, data and systems work that make that whole process a lot easier and seamless. But it still comes down to a lot of, like I talked about, the things that we're working with the acquisition team, is that it comes down to, people process, just like none of it's groundbreaking. You just have you have to execute it, right? You have to have a good plan in terms of, hey, our property manager in this market, we need to establish this weekly meeting or, every other week meeting or monthly meeting. And we need to be on the same page about what it is that the metrics are for reporting that we're all going to be focused on. And you need to go through that and just make sure that you're aligned. And if you're not, find the edge cases or find the cases that are outside of the box and work to correct those, right? But, I guess to answer the question simpler or more straightforward, I think it's finding the right fit and partner, stay engaged in terms of what you expect and and also being a good partner in terms of giving back what is expected from you as the client, which, I know may sound a little backwards, but it's a difficult, managing properties is just a very difficult activity. And I think that there's so many choices that I've been aware of, and that I think are just commonly made based on pricing. And, this is one area that I've noticed that you really get what you pay for in property management. I'm not saying that a higher margin, necessarily gets you better service, but at some point, if you're coming with 1,000 properties, that gives you, or the potential to buy 1,000 properties or even hundreds, that gives you a lot of leverage to negotiate with, the smaller the property manager goes, right, all the way down to a local market person. They'll probably agree to the cheaper pricing just to get the business. But what ends up happening is that you probably are negotiating them out of a profitable price. And so they may not be able to provide the resources and the service that you need, right? Just on that pricing, I think there's a good, there's a pretty well established market rate for what institutional level property management should be. I think there are very few opportunities where it makes sense to try to grind pricing below that.
That makes sense. So that basically is the end-to-end process of, how single family properties are sourced, diligenced, underwritten, priced, bought, and managed, which is a heavily complex process. It's a lot of moving parts. So no wonder you're encountering challenges as you grow, because all these challenges have to be solved at scale. 1,000 properties seems like a big number to a lot of listeners, but most people don't know there are 144 million addresses in the United States. So how do you benchmark your 1,000, and how do you see that changing in the near future?
Yeah, it's an interesting question. I think with our platform is a little bit unique in that, we're primarily about transactions, and we have built an asset management business to support, what happens in between. And so for us, it's as much about how many purchases and sales that we're doing, and, than it is about a portfolio. Right now, I mean, we provide services to an existing portfolio of I think it's just under 1,200 for an institutional investor, but we're not the sole provider of those asset management services. And then on our private funds, we're down to 150 properties currently in the portfolio, but that one is actively buying and selling.
Makes sense. Yeah. So you're already managing about 1,350 other properties, and that's more of how you benchmark yourself, more than how many you're buying every year.
Much more about the total number of transactions, like the buy and sale. So, so we've bought over 2,500 houses since I've been with Fortune, and sold about another 1,000.
Amazing. Now, zooming out, for people who are listening to this, two questions first is what is the biggest mistake they should avoid if they're thinking about the housing market and single family market more seriously?
I guess I can just go back to one of the things that the biggest pitfalls that I saw at the start, especially when there was such, initial and new interest from, people that come from maybe more of a financial engineering background, where is not to fall into the trap of buying, we call paper yields. So I think the biggest, the most frequent occurrence of that happening is, and it might have been exacerbated because of the distress in the market. But let's say, if you can buy a $750 rent house for 40 or 50,000, you've got a really great gross yield, and it may look like a much worse investment than buying like a $2,000 rent house for 500. But the thing is that you don't see on that, like immediately in that yield comparison, is the potential differences in the expense loads that are associated with everything. So, even though it's the $40,000 house or $40,000 or $50,000 house is worth so much less, the HVAC costs pretty much the same as that $500,000, house HVAC. The roof, obviously difference in square foot and size, all that stuff, but the roof costs pretty much the same. And so there's the fixed asset or the fixed price of so much of the cost profile doesn't change. And then on top of that is that people that can afford a $2,000 rent have different things going on in their life than people that can afford a $750 rent. And so I think that a lot of times you end up with, certain events, like things, as simple as I got a flat tire on the way to work today. Probably is, like the $2,000 renter, the worst thing that's going to happen is they're going to be late to work. The $750 renter, I mean, it can be as dramatic as, wow, I'm now like, I couldn't make a shift. And then, or maybe like now I couldn't afford to fix the flat, or, whatever it is, it can have the effect to snowball into a scenario where now I'm late on a month's rent. And, I think that scenarios like that can create a lot more volatility in the length of tenancy on that lower property, lower value rent as well. So you end up with more turn costs, which is, really the most expensive thing that you can, that comes into the cost profile of owning a rental property is turning the property. So you end up with more frequent turns, you have more volatility, you might have more delinquency, things like that. And so that paper yield fallacy, I think, is the biggest potential pitfall for, new investors.
In summary, don't be penny wise and pound foolish when you're buying homes, right? Don't let percentages of yield sway you, because, you have to really diligence the real costs involved in maintaining the property once you buy it, even if you think you probably got a steal on the acquisition price. The second question is, like, when what is the most important skill you teach your loved ones or people you're mentoring?
The hard work, I think, is like that's just kind of, I think everybody, like my daughter, I don't even have to teach her that. She already does it. I think being genuine in your interactions. And so I think that in your daily interactions with folks, like that's obvious, but it really, I think it applies all the way through. And if you take that into real estate transactions, how you transact with somebody is gonna like basically predict how many deals you can do in the future. If you might be able to have the leverage spot to grind somebody so hard that you get the discount on that property. But if you were doing that in a disingenuous way, you might have lost out on so many more opportunities to do transactions with that person in the future, right? And so I think I love to negotiate. I love to dig into it and do the best at executing transactions. I think one of the most valuable things that I try to do is just be accountable, be genuine. If there has to be a reason for why I'm doing something, and being consistent, and all these things about the element of surprise and trying to hide what it is that you're doing. Like, I just kind of feel like those are like lower tier activities, lower tier negotiation skills. Being the higher tier or the higher level negotiation skills is winning before you even start the transaction. Have your plan in place and have it set up so that you can't lose in the transaction, right? And then that enables when you step into what you're doing with such a strong plan and strategy, you're not forced to do these things that could be disingenuous or not promote valuable and solid interactions with people when you're in the midst of the transaction.
Makes perfect sense. Basically, prioritize relationships for the long term instead of the short term, right? Don't be disingenuous just to win something in the short term. Just because being accountable, being candid, being honest, like you said, is much more valuable over the long term. Amazing, Ted. So Ted, who should reach out to you and how should they reach out to you?
Anybody that wants to buy houses, feel free to send me an email. I'm sure we'll have contact info and everything available here. I also pick up my phone, so please feel free to call me direct, text, or email. I'd love to talk to you. Anybody that wants to buy properties.
Amazing. So that was Ted Farry. If you're looking to buy or sell a lot of homes, I'll add details on how you can reach out to them. If you want to talk about real estate anytime, shoot me a note on nick@home.llc. This was the Masters of Real Estate with Ted Farry. Thanks, everyone.